So this is module 2 of the weighted average cost of capital discussion. And if you recall, in the previous, the first module, we discussed the example of a firm that was trying to raise $1 million. It was raising 20% of that through debt capital. So that was 20%. The cost of debt, or the return that was the debt holders needed, the interest payment to them was the 5%. And then we subtracted out the taxes, 1 minus the tax rate. So this is exactly this. This goes here, and this 1 minus TC is this. So the weighted average cost of capital is that component. And then we include the weight on preferred stock times the expected return on preferred stock, which was 10% of it was preferred stock. And the expected return on that was 7%. Based on the information from that example, where the preferred stockholders were going to be paid 7% in dividends. And the remaining 70% was the weight on common stock, which is this. And this expected return on common stock was going to be 15%. Okay, that was given to us. And we'll talk in a minute about how we might estimate that if it's not given to us. So we take the weighted average of the cost of debt, the cost of preferred equity, and the cost of common equity, and we weight them and then we average them. So the firm's weighted average cost of capital will be 11.85%. This then becomes the firm's discount rate for any investment, any project that it is considering. Why? Because this is the minimum rate that they need to meet in order to make a project viable, because that's what they would need to generate in order to be able to meet their claims to the debt holders, to the preferred stockholders, and to the common stockholders. Okay, so that's your weighted average cost of capital. It's simply a weight, an average of the different components of capital based on their weights. And this is simply a description of this notation here. Okay. Let's talk about a little bit about how is the cost of equity determined. The cost of debt, as we saw before, was simply the interest rate on debt, or it could be the yield to maturity on debt. With equity, there's two components, preferred equity and common equity. Preferred equity is more or less like debt. And so the return, which we denoted as KP, was going to be the annual dividends paid to the preferred equity holders as a percentage of the price of the preferred shares. So this is more like your dividends over price for preferred equity. So this is your dividend yield for preferred equity. That becomes your cost of preferred equity. Why? Because these dividends are more or less given and certain, and the price is what you paid when you bought the preferred stock. So you know exactly what this is going to be. With common equity, on the other hand, it's not that straightforward. It is not your cost of equity as in the return on equity as is found in the income statement. What we want to do here is to look at what do investors expect or they require in terms of a rate of return if the firm were to sell shares on the market today. Okay? If a firm were to raise equity capital today, investors would expect a certain rate of return. Why? Because they have to bear risk for that. And what would that rate of return have to be? In order to bring in this adjustment for risk, okay, without going into too much detail, what we're going to do is use something called the capital asset pricing model, or the CAPM model. According to that model, the expected return, the required rate of return on any stock, equity, this S stands for stock, you can think about it as coming in two components. One is what's called the risk-free part of it. R sub F is the risk-free rate. Usually it's what is risk-free in the economy is usually like a government bond rate, because government bonds are assumed to be risk-free, and it's usually like a 10-year bond or some long-term bond. Okay, and that's going to be the same for no matter what stock you're looking at. Then the second part of it is an adjustment for risk. And the way we do that adjustment is, let me start with this component first. Market risk premium, MRP. What is the market risk premium? Let's consider the whole market. Okay, if we were to try to capture the returns on the entire market, one way to do it would be to look at what is the return on the S&P 500 index. If you are not aware, the S&P 500 is an index of 500 different stocks out there that make up the Standard & Poor's 500 list of stocks. And it's a broad-based measure of all the stocks traded out there. And they compute an index of all those 500 stocks and movements in that index. So if you listen to CNBC, at the end of the day, they'll talk about, did the market move up or down? It'll usually be the Dow Jones or the S&P 500 index. Dow Jones is a smaller index because it only includes 30 stocks, whereas S&P 500 includes 500 stocks. So if you look at the rate of return on this index, okay, you can actually trade this index. So when all these stocks go up or down, you get a rate of return on that. So the return on that index minus the risk-free rate. Okay, so on average, what does the stock market do? What is the return on the stock market minus something that's risk-free? This thing is your market risk premium. That's like saying on average, if the S&P 500, if the market earns, say, a 13% rate of return in any given year, if this is 13%, and if the risk-free rate is, say, 6% or 4%, whatever the case might be, this risk premium is going to be the difference of 7%. It's like the extra return that you need in order to compensate you for the risk. The very least you need 6%. What do you need over and above that to compensate you for risk as captured by this market-based index? That's what this market risk premium denotes. So you take that market risk premium, which again is going to be the same for all stocks, and then you scale that by a factor called the beta of that particular stock. Okay? You scale it up. So this beta can be a number anywhere from, it can be any number actually. It can be negative, it can be 0, it can be 1, it can be greater than 1, and so on. And as you can see from here, if this beta is greater than 1, then what's going to happen is that this MRP is going to be scaled. If beta is greater than 1, then this MRP is going to be scaled upwards. If beta is less than 1, MRP is going to go down, scaled down for this purpose. And if it's equal to 1, it's just going to be equal to MRP. So we're adjusting the rate of return we need on a particular stock up or down by this beta relative to the market in order to assess the required rate of return for the stock. Okay, and we'll talk more about what this beta stands for, but that's the mechanics of it. And this whole process is called the capital asset pricing model. Betas are published, and you can access betas. The risk-free rate and the market risk premium are also generally published, given to you. Okay, so again, the risk-free rate is usually a long-term government bond yield, such as the 10-year rate. MRP, as I said, is the risk premium on stocks relative to long-term bonds, and is often estimated based on the historical premium of around, it's usually between 4 and 6%, that premium, the difference between the market and the risk-free rate. The beta is a relationship between the return on a stock and the return on the market. Okay. Let's ignore this for a minute and come back. Beta captures the extent to which the return on a stock varies with the market. Okay, so let's say you have a stock. Let's say it is a stock like McDonald's. Okay, if the S&P 500 does very well, so the market does really well, it's a great economy, economy is booming, the market goes up, say 10%. McDonald's stock goes up, but doesn't go up by 10%, goes up by maybe 2%. Because when the market does really well, people don't necessarily eat more burgers. They probably go eat at fancy restaurants. So while it goes up by less than 10%. But when the market goes down 10%, McDonald's doesn't change very much. It goes down by only 2%. So in this case, we would say that this stock does not have too high a covariance with the market, doesn't seem to move as much with the market. On the other hand, if you have a stock, let's say Rolex brand watches, right? Let's say Rolex, or let's say Bentleys, or some fancy luxury brand. If the market does really well and goes up 10%, maybe sales of that brand goes up 20%, and so the return on that brand goes up 20%. Market goes down 10%, the brand goes down 20%. So it moves more than the market does, then you're going to have a very high beta, which also means it's very risky. Okay, so that's what this beta tries to capture. Okay, let's just do one final example before we stop this module. Suppose the risk-free rate is 4%, beta is given to you as 1.2, and the MRP is given to you as 5%. What is the firm's or the stock's expected return using the CAPM? Simply plug in these numbers and you get 10%. Okay? Beta greater than 1 means the stock is riskier than the market. In this case, actually 1.2 means that implies that it's 20% more risky than the market. Okay? On the other hand, if beta was 0.8, then that company, that stock, would be 20% less risky than the market, because the market is always assumed to have a beta of 1. Okay? So with that, we'll stop the second module and then continue with the third module.